we will be talking about the performance of the AQUA fund markets in general, as well as the outlook for the quant funds in India. Welcome to the show, Siddharth.
Hey, Kshitij. Happy to connect with you again. I think the last time I remember we had a really good conversation, and I'm happy to discuss things with you today.
Thank you for being part of the PMS Talk segment again, Siddharth. Love to have you back as well. We talked, when you launched the fund back in June 23, if I'm not wrong now, the fund has completed a good 6 to 7 months. Take us through the monthly numbers as well as, performance since inception.
Fantastic. So we've launched in mid-June 2023, and since inception, as of 15th of February 2024, we've done close to 59.7% absolute returns. BSE 500, the benchmark, has done 26 odd percent. So our alpha versus benchmark since inception in roughly 8 months is 33%. And at the same time, Nifty has done 17.8%. So AQUA has done 59.7 odd percent and Nifty has done 17.8%. So our alpha versus Nifty is close to 41.5% in the last 8 months.
Wow, that's impressive numbers. And in fact, if I remember, back then as well, what I liked about the, strategy was the style of investing. Now it is more adaptive in nature, and how, sort of it helped you in navigating the fund performance since the launch.
So I think we are adaptive across 6 key dimensions of the portfolio, which starting from asset allocation to the MCAP size mix, to our sectoral exposures, to our style tilt, and the beta of the portfolio. So what we've done in the last 7-8 months is, despite the volatility and despite the fear of valuations in India, we have managed a 100% equity allocation, which means we could have had the option to create cash, but we've stuck to our equity exposure and we've been fully deployed. So I think the equity versus cash call has helped us to a great extent. Now, the second thing in terms of our size mix. So for the first 7 months, we've been dominated by mid and small caps. So we had a mid and small cap tilt with almost 75%, 70 to 75% of the portfolio at mid and small exposures. Only 25% was at large caps. Only recently, in the latest rebalance, we have moved our large cap exposures up and we've taken it to 50%, which means the 25% allocation has increased by 100% to go to 50% for large caps, which also means we've now reduced our mid and small cap allocations. In terms of our sector weights, I think industrials, energy and utilities, diversified financials and automobiles have helped us capture significant alpha because we take a benchmark agnostic allocation. And we also, boldly been part of the whole PSU theme as well. We've had a good allocation to the whole PSU pack, from defense to NBFCs to shipping to ports, the whole energy pack, OMCs, all of it has been part of our portfolio.
And that has actually given multi-bagger returns in the recent past.
Absolutely. And finally, we've now added some allocation to healthcare over the last rebalance. Now 15% of our portfolio is in healthcare. And in terms of style, we've used a value momentum tilt, which is very interesting. So I think, as I said, there are different styles of investing. In some cycles, during uncertainty, quality and low vol does well. During economic expansion, growth does well. But when there is a lot of liquidity in the system and interest rates are higher, value does well. So we've been in a very interesting phase where interest rates are high and likely to reduce. And therefore, value and momentum has done really well. So I think that style tilt has really helped us capture the whole, PSU pack as well. And finally, the last dimension of the portfolio is the beta. So we've been in the 1.5 to 1.8 range, so high beta. And now we are gradually reducing our portfolio beta. So I think these allocations, exposures, and dynamism have really helped us generate this sort of 35 to 40% alpha in the portfolio.
Absolutely, and sounds fantastic for your investors as well. Now, in fact, before I move ahead, I would request each and everyone who's watching the live stream right now, in case they have any questions regarding the fund markets in general or about the quant strategy, do let us know. We'll try and get that answered right here on this live stream. With Siddharth. Now, let me also, quickly go on to the quantimental approach. Now, for the benefit of our readers or the viewers who are watching this live stream at this point in time, if you can explain the quantimental approach that you've been deployed and how is that different from the traditional approach?
So let me summarize this in a very simple way for you. The
Hmm.
traditional approach of investing relies on judgment,
True.
expertise, understanding, subjectivity to make investment decisions. Versus a quantitative approach relies on objective rules, processes, signals, systems to make
Hmm.
decisions. That's the basic difference. In quantamental, it uses fundamental, technical, macro, valuation, risk analytics, sector analytics, sentiment analytics. It combines all of this using quantitative techniques. So, quantamental essentially stands for quantitative plus
Hmm.
fundamental. And
Right.
what the way we define quantamental is quantitative techniques to
Hmm.
combine fundamental, technical, macro, sentiment, and alternative analytics.
Hmm.
And what we usually say is in the era of man versus machine, we believe
Right.
a man with machine approach is superior. So neither man nor machine alone can outperform the markets, but a man with machine combination is likely to
Right.
give you sustainable outcomes.
Absolutely, absolutely. We all have to sort of leverage the technology to gain strength or build strength at this point in time. Now, let me also come back and ask you. So, how do you pick stocks for investments, and how big is the portfolio, as in the number of stocks that and has that changed over a period of time, or has it remained constant?
Okay. So we usually run a 25 to 30 stock portfolio. That's the size
Okay,
that we operated. We don't want to be very concentrated. At the same time, we don't want to be extremely diversified. We want to be an
okay,
optimally diversified portfolio. Other than
absolutely.
that, the beauty of this strategy is that this runs an equal weighted strategy. We're not giving more
Okay,
weight to a certain stock just because the scores
uh,
are higher or we have more conviction on it. All the
right.
stocks get an equal weight. And what that does is gives
Hmm.
us granular outperformance rather
Hmm.
than concentrated outperformance. It gives us granular outperformance. So even in
Hmm.
the life portfolio, this equal weighted approach has contributed significantly to our returns. So,
Hmm.
on an average, 75% of the portfolio stocks
Right.
have beaten the benchmark, and
Hmm.
70% of the portfolio stocks have delivered positive returns in the holding period.
Hmm.
What this means
Okay.
is I'm generating alpha for investors, but how
Hmm.
repeatable or sustainable is that alpha? If that
Hmm.
alpha was coming from a very concentrated bet or few
Right.
winners driving the whole portfolio up, then it is not sustainable. But if
Hmm.
bulk of my portfolio is delivering performance, that means the strategy itself is sustainable in nature. Given that, let's answer how we really construct the portfolio and select stocks.
Hmm.
So there are four key steps to understand the portfolio
Okay.
construction and stock selection. We start with elimination. So
Hmm.
we eliminate from all the listed stocks, we eliminate stocks which are falling out of the top 500 by MCAP. So we use
Okay.
a size filter to eliminate stocks. So
Hmm.
once we are
Hmm.
down to top 500 by MCAP, we further eliminate another 100 stocks based on proprietary liquidity filters.
Okay.
What we
Okay.
then do is use our proprietary red flag filter to eliminate
Hmm.
stock with fundamental red flags on quality, growth,
Hmm.
governance. Again, this is done objectively, quantitatively. This is not a
Okay.
subjective analysis of which companies or management groups we don't like. If the
Hmm.
data tells us they must be eliminated, only then they are. So
Okay.
from top 500, 100 are out based on liquidity. Another
Hmm.
100 are eliminated based on red flags. So we're down to 300 stocks out of the top
Hmm.
500 members. After this, we use our success framework, which basically talks
Hmm.
about sector rotation, style alignment, superior
Hmm.
fundamentals,
Right.
sound valuation, strong technicals, and smart risk. Based on this, we assign a score to each of the 300 stocks based
Hmm.
on its sector, style, fundamental technical valuation, and volatility, and
Hmm.
try to find out stocks that across these parameters stand up tall. Now,
Right.
the idea is we use a principle of relativity. So, we are
Okay.
trying to find stocks with relatively superior fundamentals,
Hmm.
relatively sound valuations, and relatively strong technicals. At the
Okay.
same time, We want to identify stocks from the sectors where growth visibility is higher, valuation comfort is higher, investor sentiment is positive, breadth of those sectors is high, and the volatility in those sectors is lower. So
Yep.
we want to identify strong stocks from the right sectors using the right investment style as per the prevailing regime. We are not fixated to being a value investor or a quality investor or a growth
Right.
investor. We are adaptive across the style regimes. So that's step two. We rank all the stocks based on the 6S framework to identify the top stocks. Finally, we allocate to the 20, top 25 to 30 stocks using an equal weighted approach. But what is important here is that we use a benchmark agnostic allocation framework, which
Okay.
means the benchmark weight for energy and utilities could be at 7% or 10%. Currently, there is 33% allocation to the energy and utility sector in the AQUA fund.
Okay.
Similarly, financials could be at 30% in the benchmark, mainly dominated by private banks. But in my portfolio, even though I have a 35% exposure to financials, these are diversified financials. For example, PSU NBFCs, PSU banks, asset management companies, broking companies, capital market exchanges, etc.
Right.
So we've been able to use this benchmark agnostic allocation to our advantage. And finally, the step four, we have to manage risk. And again, we don't believe in predictive risk management. We believe in responsive risk management. As the data communicates to us, our portfolio is readjusted, rebalanced to manage risk.
Right. And in the meantime, so that before we go ahead, if you can also take us through the AQUA investment philosophy as well.
So the AQUA investment philosophy is very simple, and the name itself, suggests it. AQUA stands for adaptive, quantitative, unbiased, and alpha focused. So let's just go through the four key parameters of the philosophy. When we talk about adaptive, what we are essentially saying is we are adaptive across the asset classes, size. Like size means large, mid, small. Sectors.
Absolutely.
Sectors means high beta sectors, low beta sectors, cyclical sectors, structural sectors, secular sectors, and now emerging sectors. So we are adaptive across all these four sector regimes. We are adaptive across styles. We are adaptive across beta. And because this is a dynamic portfolio, we are also not fixated to the stocks in the portfolio. We're not married or attached to any particular security name. The whole idea is to be dynamic across the shifting market and macro regimes. The quantitative aspect of the philosophy talks about using a multi-dimensional approach to investing as opposed to looking at investment decisions in isolation. So when we talk about multiple dimensions, as I said, from liquidity to macros to risk to style to sentiment, fundamental, technical, valuation, we cover the entire gamut to evaluate stocks. And because it is quantitative, we take a process-oriented, rules-oriented approach. And I think that is the only thing that makes the performance more sustainable, to be honest. And when we talk about unbiased, which is the third pillar of our investment philosophy, we're basically talking about no biases towards holding periods, investment styles, management groups, sectors, or even the benchmark for that matter. And finally, all our investors come to us for alpha and not for returns. So the objective and the mandate of the strategy is to generate alpha and not just to generate returns. And our philosophy of alpha is that it must be granular. It can't be coming from one or two stocks. It must be coming from the bulk of the portfolio.
Bulk of the portfolio, right.
There are four sources of alpha in our strategy: elimination, selection, allocation, and rotation. Elimination means not having private banks in my portfolio in 22. That's alpha from elimination. Selection means being overweight, say industrials, energy, automobiles, PSU. That is alpha from selection. Allocation is how much weight am I giving to the sectors or stocks I've selected. And finally, the last source of alpha is rotation, which means how do I get out of the sectors or change my investment style as per the changing market dynamics. That is alpha from rotation. So that is the investment philosophy behind AQUA. Adaptive, quantitative, unbiased, and alpha focused.
Right. Alpha focused, that is something which will sound music to the investment ears, that is for sure. And you've done a brilliant job so far. I mean, since the time when the fund was launched. So I'm sure by the end of the year, it will be come out in finding, in very colorful theme.
Just an interesting point here, Kshitij. So we've
Uh-huh.
had 4 rebalances till now since we go
Okay.
live. And in each of those 4 rebalances, which last a period of roughly 2 months, we've generated an alpha of 6 to 8% consistently. So my
Oh.
average alpha across each of my rebalances has been 6.6%. And my
Wow.
minimum alpha is 6 and max is 8. So we've maintained a consistent alpha in each of the 4 rebalances so far. So I just thought it's an important point to highlight.
No, no, absolutely, absolutely. Now, in fact, we're also talking about the quant-based methodology, and the quant-based funds are now becoming more popular here in India as well. Now, do you think we could see dominance like the way we are seeing that in the developed markets in recent times, or in the next, probably 5 to 10 years time?
100%. I'm going to, have some interesting data here. So in US, 35% of the money is managed quantitatively as of today.
Okay.
40% is managed through passive funds, and only
Hmm.
25% is managed actively. Now, 25 years ago, in 1998,
Hmm.
89% of the money was managed actively, and only 11% was via passive and quant. So if you
Hmm.
see the shift, 89% active is down to 25%,
Right.
and 11% passive and quant is almost at 75%. So that's a
Hmm.
huge regime shift. Now, in terms of India, the quant share is 1.2%, which
Right.
was 0.4%, I think, 3 years back. So there
Hmm.
has been a large, market share gain for quant.
Hmm.
Passive is at close to 15-20%, and active is still at close to 80% odd.
Right.
So I think a lot of scope exists. And an interesting data here is 91% of all the quant strategies in India have
Hmm.
outperformed their benchmarks in the last 5 years, versus
Okay.
only 39% of the active funds have been managed to beat their benchmark in the last 5 years. So I think, driven by superior performance, better risk management, and
Right.
process driven performance, quant funds must grow in India as well. So from 270 crores in 2013, we are
Hmm.
now at 63,000 crores in 2023. While it's a low number on an absolute level, that's a
Right.
230x growth in the last decade alone. So I
Hmm.
think, the data and numbers should give you the answer of what quant
No,
looks like
no.
in India.
Absolutely. In fact, it's heartening to see that retail investors or investors in general are also adapting to the newer ways of investing. Because till this time, we were only aware that something like this used to happen in the developed markets like the US, but the first-hand experience was something which was not there. But now, because investment funds like you, they've come, and you're also interacting with the clients, you're also interacting with the investors, and they're also experiencing how the fund works. I think this is something which will only add on to the experience, which will add on to the AUM in the near future. That's what we also observe.
100%. I finally think in every market, you can sell narratives,
Absolutely.
stories,
Yeah. Yeah.
theories only for some time. Beyond
Mm.
that, performance is the metric that will drive growth. You can't be selling stories and gaining AUM. You must be selling performance to get AUM.
Absolutely. Now, while you are there on the live stream, we want to ask you as well. What is your call in the markets? That the basic question which definitely a journalist would want to ask, especially in the financial domain, and how you're looking at it in terms of valuation with respect to India and the global pairs, and also I think you've also highlighted what the sectors that you're overweight on. So you just added healthcare to your portfolio. Any other sectors which are looking attractive at this point in time?
Sure. So I think that's a lot of questions. Let me just handle them one by one.
Sure.
So, in terms of my medium to long term view, I think very positive on India and a very positive bias towards Indian equities as an asset.
Mm.
This is mainly driven by the robust macros, the stable geopolitical positioning of India versus the very turbulent world everywhere else. We have a very resilient domestic economy, a very bright export opportunity, global export opportunity, which didn't exist probably for the last decade. It was only a
Mm.
service oriented export. Now it's a product and manufacturing oriented export as well. And coupled
Mm.
with all of this, discretionary consumption, urban consumption, and extremely strong government capex and government infra capex. I think
Okay.
very, very structural drivers for economic growth in India. And as India is moving from an emerging to a developed market and a developed economy, I think all the levers we need for this growth journey over the next 7 to 10 years, whether it's in terms of defense, whether it's in terms of order books, roads and rail and shipping and port infra, factory output, I think all of it is really, really strong. Coupled with that, the other major metric for India is the liquidity and flows. So I think
Right.
growth, economic growth and corporate growth drives market growth till a certain level. The other component that supports market growth is the valuation multiples. And
Right.
valuation multiples, in essence, are supported by liquidity. Given the robust financializations of savings, record MFAUM crossing 50 lakh crores, record SIP books more than 18,000 crores now, I
Right.
think the domestic liquidity coupled with foreign liquidity is going to drive and hold the multiples to a high level for this decade. With China getting out of the global picture in terms of fund allocations, India
Right.
being the fourth largest market and the third largest economy by 2028 is going to be the clear beneficiary. So I think India's growth differential versus the larger economies in the world and the longevity of growth that India is now seeing, both of them will keep India as an expensive market for the decade to come.
Okay.
Obviously, we can expect some volatility in the near to medium term because we are already coming out of a very strong rally. Now,
Exactly. Right.
in terms of our market positioning, I think we're more tilted now towards large caps as opposed to mid and small caps
Okay.
because mid and small caps are trading 75% of mid and small caps are trading at more than one standard deviation valuation compared to the
Okay.
3 year averages, and more than 65% of mid and small caps are trading at 1 SD above their 5 year averages. At the
Okay.
same time, large caps are the most undervalued they've been versus mid and small since 2006. So there is a clear valuation differentiation or differential in the large pockets of the market and the smaller pockets of the market. So I think this should narrow down in times to come. So our positioning is towards larger caps now, and we do expect higher volatility in the broader markets.
Right. Now, before I move ahead, we got a couple of questions from our chat box. Now, Manish Gupta wanted to ask you, uh, so if in case we want to invest in the fund right now, so is the fund open, or because again, the NFO of the fund was already it's already launched, so does it make sense to enter now, or
So it's a open-ended equity scheme, FlexiCap
it's an open?
PMS. It's an open-ended, so people can come in whenever, they can leave whenever. No constraints there.
All right. All right. And there's another question that we have. So the Tarun, I'm sure there's no question as such, but he said that he's already invested in a quant fund, which is a small cap fund, and any other quant fund for alpha return. That means I think probably he wanted to ask you that will this aqua fund will also be something which will be in the same league. That means can that be a small cap fund, or it will also help him to diversify in terms of other related stocks? Because I
Okay, I
think he
think
already had a small cap.
that's a very good question. So let me just clarify at the outset. We are a FlexiCap strategy. What FlexiCap means is, if we are in a risk-on, expanding and bull market phase, this fund behaves like a mid and small cap fund. As we start becoming more defensive, as the market and macro cycle changes, this starts increasing its large cap allocation. So yes,
Okay.
we invest across large, mid, and small, but we adjust the exposure to these three pockets of the market dynamically. So sometimes it has more tilt towards large cap and sometimes more towards mid and small cap. In an extreme situation where we foresee systemic risk, we are also allowed to create cash up to 50% in the portfolio.
Okay.
So it does give you a diversified exposure. At the same time, this diversification is dynamic and not static. You don't need to take a call as an investor when to
Exactly. Right.
invest in small, mid, or large. We do that for you.
Right. And so before we move ahead, if you can also elaborate on the risk, how do you manage risk in the fund as well, Siddharth?
Sure. So we look at risk in two ways.
Mm-hmm.
One is how to deal with known risks. So that is a part of strategic risk mitigation, mitigating the risks that we know at the outset. The other component is dealing with unknown risks. That is a part of our dynamic risk management model. So I will just briefly touch upon both segments of risk management. To deal with known risks, as I said, we use liquidity filters to deal with liquidity risks. We use fundamental filters and eliminate another 100 stocks to deal with fundamental risks. We follow a benchmark agnostic and unconstrained allocation to deal with allocation risks. We are an optimally diversified portfolio of 25 to 30 stocks using an equal weighted method. So that's how we're dealing with diversification risk. Maximum 4% allocation per stock at the time of entry. We neither want to be overly diversified nor overly concentrated.
Right.
The next risk is concentration risk. We are well distributed, granular in terms of our profit mix as well at the portfolio level, with more than 65% of the stocks outperforming on an average. And the last is timing and opportunity risk. Every 2 months, the portfolio is reviewed and rebalanced in order to probably exit some stocks, change the sector mix, change the style mix if needed, or change the asset class mix. So we are very, very unbiased in terms of exiting and eliminating laggards in the portfolio and replacing them with stronger stocks. So these are the methods we use to deal with the risks that we could know from the beginning. Then there are a lot of risks which we don't know, and they just happen over time, right?
Exactly. The black swan events.
Exactly. So the dynamic risk management model looks at 6 things. First is dealing with systemic asset class risks by creating cash in the portfolio. This is powered by our macro models. They track valuations, risk appetite, sentiment, market breadth, technicals, liquidity, monetary conditions, and overall global macros to give us a signal when is the time to move out of equity as an asset class and move into cash up to 50% to create some buffers in the portfolio. The other risk is size risk. As we know, mid and small caps are very cyclical assets. Large caps tend to underperform tremendously when mid and small caps are outperforming. So how to manage this risk? Again, we are dynamic and flexible and unbiased. So our models tell us when to change our mix in terms of size. We also reduce the portfolio beta to manage beta risk. We move out of cyclical high beta sectors to increase exposure to more structural and secular sectors with a lower beta to manage sector risk. Similarly, we deal with style risk by improving or increasing a quality and low volatility tilt in our portfolio if the regime so demands. And finally, because we are absolutely unemotional about the stocks we own, we simply replace them as they start weakening or other stocks start strengthening relative to the ones we own. So this is how we deal with asset class size, beta, sector, style, and security risk.
Right. No, in fact, very well said there. And I hope our listeners and viewers take note of that. We got a very interesting question, Siddharth. And this question comes from Dhirendra Tiwari. Now, he wanted to ask you that why no personal finance experts on TV channels ever recommend quant funds despite best of the returns?
Okay, so I think I can't really answer that. Probably that's a limitation.
So I got you in a fix there.
That's a limitation of the personal finance expert, probably a lack of ability or understanding of how to evaluate a quant strategy. Because quant is new and nascent in India. As I said, it's only 1%. Bulk of our personal finance experts are used to active funds, which is for the last 20 years, they've dominated the market. So I think as India is building its quantitative capabilities in terms of investing, the personal finance experts must also build their capabilities in terms of understanding, evaluating, and recommending quantitative strategies.
Right. Well, I hope Dhirendra, and we got a similar question coming in from Shubham as well, Shubham Joshi. So I hope Dhirendra and Shubham, you got your answers there. That yes, it is still early times for quant funds here in India, but rest assured, I think in few years' time, the AUM will be something which you will see at par with passive as well as equity funds, and probably it will increase more than the equity or the active style of investing funds as well. Now, before we wrap it up, I think one question which remains unanswered is what is your exit strategy? When do you press the sell button and you think that, okay, that's fine, I've got all the clearances, all the red flags here, and this is time to exit the stock?
So the stock exit strategy is very, very simple. As I said, every security is ranked on their asset, liquidity, size, sector, style, fundamental, lot of parameters, right? Assume we use 15 different factors to evaluate all the stocks.
Mm,
And based on the regime we are in, the weights to these factors differ. So, for
mm,
example, in a value regime, valuation as a factor would get more weight. In a momentum regime, probably momentum would get more weight. In a quality regime, quality would get more weight. Similarly,
mm.
based on the regime, the weightages to these factors that we use to evaluate stocks keeps changing. And at the end of it, we get a total score for each and every security. So now we exit a stock in one of the two situations. Firstly, on an absolute basis, one of the
Mm.
portfolio stocks or the stock that we want to exit is
Right.
weakening on an absolute basis, and
Mm.
therefore it must be sold. And weakening doesn't mean it's not a subjective thing, it's an objective thing. The
Okay.
score, the total score of the stock starts dropping. That means there is something going wrong in multiple of the factors that we are evaluating. So it
Right.
must be exited. The other scenario is on a relative basis,
Mm.
either my stock is relatively weakening versus the rest, or some other stocks are becoming more strong in
More
terms of
stronger.
their
Yeah.
sector, style, fundamental valuation parameters compared to the ones I'm owning. In which
Mm.
case, also, I will replace the weaker stock with the stronger stocks based on their
Mm.
multidimensional or multi-factor score that we evaluate. So, this is how we exit stock. The other thing is, how do we create cash in the portfolio? I think that again
Mm.
is very important. As I
Right.
said, we track global risk signals, global
Okay.
macros,
Mm.
fund flows, liquidity conditions, interest rates and monetary conditions, sentiment and breadth measures,
Mm.
valuations across the different asset classes, and trend analysis across the different asset classes. Based
Okay.
on a combined signal using all these, our
Mm.
models tell us when equity, and more particularly Indian equity as an asset class, is going out of
Mm.
favor, and we must create cash because, irrespective of what stock we own, the portfolio is going to bleed. So, the
Correct.
idea is, in a bear market, we're not able to deliver outperformance on the upside, but we are
Mm.
able to deliver outperformance on the downside. So, if the market falls 50%, and if my
Right.
strategy or portfolio falls 25%, a
Exactly.
25%
Then,
negative return on an absolute basis is bad. But the moment you
mm.
look at the relative lens of the market, that is
Mm.
still me satisfying the mandate of alpha or outperformance.
Absolutely. Now, in fact, before I wrap it up, we got one question from Dhiren, and he's insisted me to ask you this question that, if you can suggest some robust sectors for this quarter and the next quarter, considering we are heading for elections as well. But Dhiren, you should also understand that, in the quant strategy, we focus on the numbers. We look at the numbers as a sacrosanct figure before Siddharth goes and tells that this sector is attractive or this sector is looking bad. But over to you, Siddharth. You can
So,
take it from
so
there.
I will. What I will do is, I will not give you any recommendations, but I will tell you what we own in the fund, and
Hmm.
our view holds at a max for the next 2 months only.
Okay.
I fully have the right to change my view after 2 months. So currently, 33% of our portfolio is in the energy and utility space. Close to 13% of our portfolio is in the industrial space.
Hmm.
17% is in financials. By financials, again, I don't mean private banks. It could be PFCs, RECs, NBFCs, PSU banks, capital market exchanges, BSEs of the world, AMCs, all of these. So it's diversified financials. 17% of our portfolio is in automobiles, and roughly
Hmm.
10-11% of our portfolio is in healthcare. So if I look
Right.
at the top five sectors, it's energy and utilities,
Hmm.
automobiles, financials, industrials, and healthcare. These are the sectors that we currently own in the portfolio.
Right. Well, I hope
And
there is
50% of our portfolio is large cap now, as opposed to 22% of the portfolio being large cap in the previous rebalance.
right. Well, I hope then you got your answer there. And well, on that note, Siddharth, thank you so much for your time. And that's all for now. But do stay log on to ET Markets live stream for more on news, business, and economy. Again, thank you so much for your time, Siddharth. Great connecting
Thank
with
you
you.
so much, Shidhar. It was a pleasure speaking to you.